Welcome back to the Deep Dive. Today is Friday, January 23rd, 2026. We are looking at the markets this morning, and I have to say, it feels like the financial world is having a bit of a split personality episode.
It really does.
We're working off the latest vivimoneyDaily report, and honestly, the signals are just flashing red, green, and gold all at the same time.
It's a definitely confused morning. If you just look at the data, it's like capital can't decide if it wants to go all in on the future with AI or, hide in a bunker with gold bars.
That is exactly the vibe I'm getting, this massive tug of war. So, just to set the scene for everyone listening, our mission today is to decode this specific landscape, where capital is violently toggling between what I'm calling AI offense and precious metal defense.
That's the perfect way to frame it. It's offense versus defense happening at the exact same time.
And before we get into the weeds, and we are definitely getting into the weeds today, let me just hit you with the top-level headlines from the report.
Let's do it.
First, the 10-year Treasury yield is just refusing to budge, and it's putting serious pressure on valuations. Second, Bitcoin has seen hundreds of millions in liquidations in, just 48 hours?
Wow.
And third, and this is the one that really jumps off the page for me, gold is knocking on the door of $5,000.
5,000. It's a massive psychological number, but the data says we are right there.
So we have you here to help us make sense of all this. When you look at the report, zoomed all the way out, what's the so what? What's the real tension driving the chaos?
The central tension is really about trust versus memory. I mean, on one hand, you have core inflation falling. The report explicitly says it's tracking downward.
Yeah.
And in a textbook, that signals, party time. Rate cuts are coming. Liquidity should be easy. Buy everything. But on the other hand, you have what we're calling liquidity memory. And of course, geopolitical risks that are just keeping volatility incredibly high.
Liquidity memory. I love that term, but it sounds a little ominous. Like the market is holding a grudge.
It is a little ominous. It essentially means the market is haunted by what happened just a few weeks ago at the end of 2025, even if today's data looks okay on the surface.
Okay, let's unpack that macro environment first, because that sets the table for everything. We mentioned the 10-year. The report puts it in a very specific range, 4.15 to 4.30%. Why is that range so critical right now?
Because that is the danger zone for high-growth stocks. You have to think of the 10-year yield as like the force of gravity for the stock market.
Okay.
When you have a risk-free rate hovering above 4.15, it makes it very, very expensive to justify the sky-high valuations of tech companies. The report literally says it's exerting valuation pressure.
So it's just math. If I can get 4.3% risk-free, your risky tech stock needs to promise me a whole lot more to be worth it.
Precisely. It pushes the discount rate up. The higher that yield goes, the heavier gravity feels for a company like Tesla or, NVIDIA. They have to sprint just to stay in the same place.
So even with a perfect AI story, the math gets harder at 4.30. Okay, let's go back to that liquidity memory concept you brought up. This is fascinating. The market is still obsessing over something that happened on December 31st, 2025. Weeks ago. Why?
Because the numbers on New Year's Eve were massive, and they revealed some cracks in the plumbing. The report cites the standing repo facility, the SRF usage, at $74.6 billion.
Okay.
And the overnight reverse repo, the ONRP, was at $106 billion.
Whoa. Let's just pause there. $106 billion in reverse repo. Can you translate that for someone who isn't a bond trader? What does that actually mean?
Sure. The overnight reverse repo is basically where banks and money market funds can park cash at the Fed overnight when they don't want to lend it out anywhere else. It's like a safety mattress.
So if there's $106 billion sitting there,
it means there's a lot of cash that is scared to go into the real economy.
It's fear money.
Exactly. And on the flip side, that standing repo facility usage of $74.6 billion means other banks were desperate for cash and had to borrow from the Fed. So you had this really weird dynamic on December 31st.
Some people hoarding cash, others desperate for it. And even though that was a year-end thing, the memory just lingers.
It does. I mean, even though they were technical maneuvers, the market is citing these figures today as indicators of short-term liquidity risk.
So it's like the market saw a ghost on New Year's Eve, and it's still sleeping with the lights on.
That's a great analogy. They're worried the plumbing of the financial system is tighter than the Fed is admitting.
Sleeping with the lights on. So while everyone's nervous about the plumbing, what about actual jobs? The report says the labor market is shifting.
It is. We're seeing a transition from what we called super hot to just normal. The December non-farm payrolls came in at approximately plus 50,000.
Only 50,000. Wow. That feels low. We were seeing huge numbers for a while there.
It's a clear slowdown, and the unemployment rate is sitting near 4.4%. Now, the report is careful to point out this isn't a systemic deterioration.
The sky isn't falling.
The sky is not falling. We aren't in a collapse. But the sheet is definitely off.
So a cooling trend, which, usually leads to rate cuts. But you mentioned inflation earlier. Is that cooling too, or?
Okay. Technically, yes. Core inflation is tracking downward, and this is fueling those bets that the Fed will cut rates. But, and there is always a but in 2026.
Always a but.
The report highlights that future Fed decisions are clouded by, and I'm quoting, political and judicial controversies.
Yes. The chaos factor.
Right. So we can look at the math, but we can't ignore the political noise. The Fed's path isn't just about data anymore. It's about navigating a minefield.
So that sets the stage. Cooling jobs, scary repo plumbing, stubborn yields, and a politically stressed Fed. Now let's talk about how traders are behaving in this mess. You call it a tug of war.
It's a binary flow of funds. This is really important to grasp. Money isn't just spreading out evenly. It is aggressively switching between two camps. Camp A, AI offense. Camp B, precious metal defense.
Risk on and risk off at the same time.
Depending on the hour, yes. And the report notes that early-year trading volume is thin. That means it doesn't take much to swing the market violently.
And when things move violently, people get scared. What's the VIX, the fear index, telling us?
The VIX is showing these intraday spikes. It's touching approximately 20. Now, 20 isn't full-blown panic.
Right, panic is like 30 or 40.
Exactly. But 20 indicates rising hedging costs. People are paying more to insure their portfolios. They're nervous.
But speaking of nervous, let's look at crypto. The fear and greed index there has shifted, hasn't it?
Oh, significantly. We've retreated from greed and chasing highs to a much more cautious stance. And that is directly tied to those liquidations we mentioned.
Right.
When you wipe out hundreds of millions of dollars in leverage, the greed tends to evaporate pretty quickly.
Okay, let's drill down into that. I want to do a proper asset class deep dive. Let's start with equities. If I'm an investor looking at my screen today, what am I seeing?
If you're looking at the S&P 500, so VOO, you're seeing high-level consolidation. It's just stuck. It wants to go up, but it's being held back by those macro factors we talked about.
And the NASDAQ? QQQM.
That's a different beast. The report says it's being dominated by AI and semiconductor news. It's less about the broad economy and more about specific tech narratives.
Which brings us to the king of the north, NVIDIA.
NVDA. Still the core focus for capital. The report calls it the AI infrastructure leader. Even with all this fear, if money wants to go on offense, that's where it goes. It's the default bet.
What about Tesla? TSLA seems to be on its own wild ride.
Tesla's being driven by delivery numbers and product pacing. It's volatile, but for different reasons. It's about execution. Then you have Meta and Google, and their valuations are tied to their AI capital expenditure.
The market's asking, is the spending working?
Exactly. That, and how is the ad market doing?
So they're under the microscope. Now, here's something that really caught my eye. Pre-stocks. Anthropic, XAI, OpenAI. These aren't public companies, but people are trading them.
They are. This is the frontier. The report mentions secondary market trading for these names. Basically, employees or early investors selling their shares to wealthy buyers before an IPO.
But, and I feel a huge warning coming here, is this safe?
There is a huge warning. The report explicitly says these are high-risk, illiquid, and show large spreads.
Large spreads, meaning the difference between what you can buy it for and sell it for is huge.
Exactly. You might buy it at 50, and the instant you want to sell, the bid is only 40. You lose money just on the trade itself.
So don't bet the farm on XAI just yet.
Please don't. The report says these are strictly for small positions, speculation, or hedging. Do not treat these like Apple or Microsoft. The liquidity just isn't there.
Okay, let's pivot the other side of the tug of war. Crypto and commodities. We mentioned Bitcoin liquidations. Give us the numbers.
The report has a precise price range for Bitcoin right now. $89,000 to $90,000.
That feels like a bit of a drop. We were flirting with 100K not long ago.
We were, and that's where the resistance is. The report notes key resistance remains at 95K to 98K. We just couldn't break through. But the big story is the long liquidations. Hundreds of millions of dollars of bullish bets wiped out in 24 to 48 hours.
Ouch. So the leverage got flushed out.
Completely flushed. And you see that ripple across the altcoins. Ethereum is tracking Bitcoin, sitting at 3,100 to 3,300. Solana is showing high volatility around 130 to 140.
And BNB.
Binance Coin is moving with market sentiment, priced between 880 and 920. But the report also mentions one more ticker I have to bring up, HYPE.
HYPE, is that the actual name?
That's the ticker, and it lives up to it. The report tags it as high speculation with liquidity risks. So, proceed with caution.
Got it. So crypto is licking its wounds. Now let's talk about the star performer, the asset shining the brightest today, gold.
Gold is absolutely the story of the day. Spot gold is trading around $4,956 an ounce.
Almost 5,000. That is incredible. I remember when 2,000 felt expensive.
It's historic, and the report confirms this isn't just speculation, it's safe haven demand and institutional buying. Remember that defense camp we talked about? This is it.
Right.
Big money central banks, massive funds, they're scared, so they are parking cash in physical gold.
How does the dollar factor in? Usually a strong dollar hurts gold.
Correct. And right now, the dollar index, the DXY, is fluctuating between 98.3 and 98.9. That's relatively weak, and that weakness is acting as a tailwind for this gold rally.
And quickly on oil, is it joining the party?
Not really. WTI is ranging 59 to 60 a barrel, Brent around 64. It's stable, influenced by inventory and geopolitics. It's not the headline grabber today.
Okay, we've laid out the board. The listener's thinking, great, but what do I do? Let's get to strategy and key takeaways. If you had to summarize this whole report in one sentence, what would it be?
I'm going to use the source's own conclusion because it's perfect. In a backdrop of falling core inflation and rate cut bets, short-term liquidity memories and uncertainty are keeping volatility high, forcing capital to switch between AI growth and precious metal safety.
That sums it up. The switch is the key. So what's the actionable strategy? The report gives a defense-first approach. What's that look like?
Rule number 1, defense first. The report suggests prioritizing VOO or QQQM as core holdings. Don't try to be a hero picking random stocks with your whole portfolio. Stick to the broad indices.
But what if I still want to play the AI boom? What about NVIDIA?
You can play it, but use a phased approach. The report suggests buying the dip, but slowly. Dollar cost average, don't back the truck up all at once. And crucially, it says to use cash buffers or options protection.
Options protection, so buying puts.
Yeah, buying puts, basically insurance policies on your stocks.
Yeah.
If the market drops, the put option makes money, offsetting your losses.
Smart. And the hedge. Gold.
Moderate allocation to a gold ETF or physical. With gold near 5,000, it's clearly working as a hedge against systemic risk. You want some of that insurance in the portfolio.
And for the crypto traders listening, any advice from the report?
Caution. Extreme caution. After those liquidations, the report advises small positions and strict stop losses. You have to watch the leverage. The market just punished the greedy. Don't be greedy right now.
And finally, cash. Is cash trash or is cash king?
Cash is king when volatility is this high. The report emphasizes maintaining sufficient cash or short-term bonds. You need to be able to deploy quickly if liquidity turns.
Keep your powder dry.
Exactly. If the market crashes, you want dry powder to buy the bottom. If you're fully invested, you're just a passenger. If you have cash, you're a player.
I like it. A balanced strategy. Acknowledges the upside in AI, but respects the very real risks.
You have to.
We're coming up on the end of the dive, but before we go, I want to leave the listener with something to think about. We talked about liquidity memory, how the market is haunted by December 31st.
We did. And here's the provocative thought I want to leave you with. If the entire global financial market, this, multi-trillion-dollar system, is still flinching because of technical operations that happened weeks ago, how fragile is the confidence in our financial plumbing, really?
That's the question. Are we one technical glitch away from a real freeze?
When you're sleeping with the lights on, every shadow looks like a monster. The question is, are there real monsters in the closet? Or are we just scared of the dark?
On that cheerful note, keep your eyes on the data. Watch out for the upcoming PCE and CPI prints. Those are going to be the next big movers.
Absolutely. The data will tell the story.
This has been the Deep Dive on the Vivi Daily for Jan 23, 2026. Stay liquid, stay safe, and we'll catch you on the next one.